There's no such thing as job security in a large organization. I'm much more secure about my job now that I run my own business rather than when I was in a bank. Because here I decide, nobody else decides. Unfortunately, in a large organization, you're never in charge of your own destiny. There'll be a change of direction, new management, new strategy. Someone is in head office deciding for you how fast to run, how slowly to run. And I wanted to be in charge of my own destiny.
When you're at the bank and you're at a very senior level, what are some of the things that you observed that could have been done better?
Look, I think the industry is unfortunately not very honest. I have to say that. And you can say guilty as charged. I was part of that until 2008 or 2009. They have very tough targets to achieve, so they have to sell stuff. Many of the things they sell to their clients, the clients don't really need.
What exactly is an independent asset manager and how is it different from banks?
We are independent, so we can have unbiased advice for our clients. We keep custody and execution with the bank, so the client keeps a bank account, but we are the investment advisor or the investment manager, completely separate from what the bank would be doing.
You would then charge the client a separate fee for advisory?
We charge a fee, an advisor fee or management fee, which is usually a percentage of the assets under management. So there's no incentive to churn an account. There's no incentive to sell a mutual fund because of a trailer fee and things like that. The big difference really is I work for the client. As a relationship manager in the bank, I worked for the bank.
What are some of the common mistakes that you see investors make today?
Oh, they always make the same mistake.
Which is?
I'm Nicole Lee and welcome to You Never Know, where we talk about life, career, finance, and health with visionary people who have taken the unconventional road and embraced the unknowns. If this episode resonates with you, I would love for you to like, subscribe, and share it with someone who might need it today. Are you ready? Let's go.
What does it take to walk away from a senior banking career and pioneer a whole new way of serving high net worth clients? Today's guest moved from Switzerland to Singapore in 1986 and spent more than 3 decades in wealth management, where he led private banking businesses in Asia across Credit Suisse, ABN AMRO, and Clariden Leu. And in 2009, he made the bold move to found HP Wealth Management, now one of the largest independent asset managers in Singapore. 16 years on, he's not only proven that success is possible outside of the big banks, he's also a respected voice in how the wealth management model must evolve. Passionate in wealth, politics, and football, today we're going to discover more about his career journey, the business model of an independent asset manager, and how he thrives in life and finance beyond the safety net of large financial institutions. It is my absolute pleasure to welcome Urs Brutsch to You Never Know. Welcome to the show, Urs.
Thanks for having me. Thank you very much.
Very good to see you again. Urs, you are a veteran in the financial industry. You actually started your career 50 years ago as an apprentice in Credit Suisse in Switzerland. Did you ever imagine that you'd be still here in Singapore today on a podcast talking about the wealth management business?
Absolutely not. By the way, I was 15 when I started off.
Wow.
So been 49 years in banking and wealth management, so that makes me 64.
You know, looking back at 15-year-old Urs, what was he thinking at that time?
I wasn't thinking too much at that time, to be honest. But no, I think I joined the bank Credit Suisse in Switzerland because I was quite clear I want to be working in a bank. My friends were in a bank. My dad at some point was in a bank previously. So it was quite a logical choice. But I always wanted to work abroad. That was always one of the things I wanted to do. Did I know I would go to Singapore? Of course not. Did I know I would stay away for so long? Of course not. But so I didn't think too much, but I wanted to go abroad. And yeah, it did happen at some point.
Okay. So Urs, fast forward to, 30, 40, 50 years later, you spent more than 30 years in banking, right? You actually were in very senior positions, leading private banking at Credit Suisse, ABN AMRO, Clariden Leu. You even opened the first branch in Singapore for Clariden Leu. Why did you decide to leave banking and then start your own independent asset management business?
I think deep inside, I was always an entrepreneur. And I helped build businesses for Credit Suisse, for ABN and for Clariden. And I like that. I like to build stuff. But unfortunately, in a large organization, invariably, there'll be a change of direction, new management, new strategy, and other people taking credit for what you have done. And so there's a change, and at some point you have to make a move, and you're never in charge of your own destiny.
Yeah.
Someone is in head office deciding for you, giving you the head count, telling you the strategy, how fast to run, how slowly to run. And I wanted to be in charge of my own destiny. That was the main driver, really.
I find it very interesting because you were so senior and yet you feel this way. And many other people in banks at this point in time are struggling and feeling like they don't really feel as empowered as they should be.
I think a lot of people in banks, and I talk to a lot of friends in banks still, I think they all would like to be outside the bank. I think the pressure they have, the pressure to perform, to sell stuff, and the compliance pressure and all that is enormous. And I think many of them would want to do something else, but either they don't have the clientele in our business, they don't have enough clients to go on their own, start their own business. They don't have an entrepreneurial spirit, which you need if you want to do something on your own, obviously. And I think they like the comfort of a big bank. And I think comfort should be in inverted commas. I think there's no such thing as job security in a large organization. I'm much more secure about my job now that I run my own business rather than when I was in a bank. Because I decide, nobody else decides.
Yeah, let's dive deeper into that, because a lot of people do say that, I don't leave the bank because it's very secure, it's safe. Why do you say that having your own business now is actually more secure than actually having a job in the bank?
Well, I think, again, in the bank, you're at the mercy of your line managers. If they decide we don't need that level of management, we can do without, then you're gone.
Yeah.
Unless you're a top performer with, a large client book, then obviously they keep you. But I think you're always very vulnerable in a bank, the downsizing, change of strategy, change of direction, and you're vulnerable at every level of the pyramid if you want. Whereas when you have your own business, again, nobody will decide for you. You don't have to ask anybody in HR and compliance. You decide what you do.
Yeah. So you didn't want to leave for another bank, which you could, right? You could easily do that.
Yes and no. I mean, look, I always wanted to be on my own. I thought about it long before when I left Credit Suisse in 1999. But I think I wasn't ready and the market was not ready for the business model that we run. But also in Clariden, we had a major accident happening in Hong Kong. And as at the top of the food chain, you have to take responsibility. So that I had a bit of a push in that sense. I resigned because of that. But it gave me the motivation to tell me that's the time. The timing is right now to do it on your own.
Right.
And no regrets whatsoever.
Tell us when you're at the bank and you're at a very senior level, what are some of the things that you observed that you felt could have been done better?
Look, I think the industry is unfortunately not very honest. I have to say that. And you can say guilty as charged. I was part of that until 2008 or 2009. I think far too often the client is not really first on mind for the banks or the bankers. They have very tough targets to achieve, so they have to sell stuff. And many of the things they sell to their clients, the clients don't really need. So structured products, for example. I mean, I wouldn't want to be a client that gets a call every day about a new structured product, because I know there's a lot of fees built in for the bank, which they don't disclose too openly. So I think we were not honest with our clients. And I felt there's a better way to look after a client, in a more honest way to do that. And I think when we started in 2009, nobody really knew our business model. There was a few IAMs already, or independent asset managers, but it's a very, very small subsegment of wealth management. And the way we started, we only wanted to be paid by the clients. So no revenue sharing with the banks, which will encourage you to take more risk, make more transactions, churn the account so that you make more money. We stayed away from that. And that was perhaps why it took us a little bit longer to be successful.
Okay, I think it's a good segue into understanding more about this IAM EAM space. And for the audience who don't really know what is IAM and EAM, it's Independent Asset Manager, IAM, and External Asset Manager, EAM. And for the sake of this podcast, we're going to use these abbreviations interchangeably. I'm going to ask a very basic and fundamental question. What exactly is an independent asset manager, and how is it different from banks?
Okay, so as the name would suggest, we are independent. We're not beholden to anybody. So we can have unbiased advice for our clients. We don't have our own products to sell. So maybe roll back a little bit. If you work with a bank, as a client with a bank, a UBS, a DBS, a JP Morgan, you basically get the advice from the bank, you get the custody with the bank, and execution of your trades with the bank. So when we come in, we basically unbundle that and we take away the advice or the management of the money. We keep custody and execution with the bank. So the client keeps a bank account with a DBS or UBS or whatever, but we are the investment advisor or the investment manager, completely separate from what the bank would be doing. But we then give the instructions to the bank based on the agreement we have with the client, either investment management, discretionary, or advisory.
Right. So the client and you mainly use the banks for custody and execution. And you take away the advisory bit, or not take
Which
away,
the bank
but you
would have done before.
Exactly.
Yeah.
Okay. And then you would then charge the client a separate fee for advisory?
We charge a fee, an advisory fee or management fee, which is usually a percentage of the assets under management. I think the big difference really is in our model, I work for the client. As a relationship manager in the bank, I worked for the bank.
Yeah.
So my loyalty had to be first and foremost to the bank, because they paid me. But now the client pays me. So I think for the client, and I would only do what's right for the client. And again, whatever I do for the portfolio, I'm not making more money because I do something, sell a fancy product or something like that. No, I don't make more money because of that.
Okay, there are a couple of layers here. One is it also because of the way the advisors are compensated in an EAM?
Yep.
Right? Because you're saying that, for example, if I'm a relationship manager and I work for UBS and DBS, I get paid a base salary, a pretty high base salary actually.
And the bonus.
And a bonus, pretty big bonus, depending on whether you meet your targets, right? So all those layers come in. And is that different to how, let's say, a relationship manager would be compensated in an EM?
Yes. First of all, we don't have targets. We do not set targets to our staff.
Okay.
We have a revenue sharing agreement with our relationship managers, and they get a percentage of the invoices we can issue for the clients for investment management or advisory. They get a cut, 50 or 60%, depending on the level where they are. Around 60%, let's say. They get 60%.
Okay.
Now, they get 60% of the fee we charge, and that fee charged is only based on AUM, not based on transactions. So there's no incentive to churn an account. There's no incentive to sell a mutual fund because of a trailer fee and things like that. So we're not poisoned in our thinking what we should do for the client.
Right. So how you charge a client is based on the AUM, which is assets under management.
Yeah.
So in that sense, you are quite aligned with the client, because if the investments perform, the AUM, the assets will increase.
Correct.
And therefore, the client is happy.
Yes.
But you are also happy because your fees go up.
And I'll be even happier because he's happy with us and he introduces his friends to us. That's how we normally get new clients anyway.
Right. Okay. So just to clarify, an advisor or a relationship manager in an EAM does not actually get a base salary.
No.
Right. No. And therefore, he does not have to, like you say, work for the bank to meet a certain KPI in order to cover his base salary, which is usually the case if you work for a bank.
Yes, correct.
Right.
We have no KPIs. We don't have, again, as I said, we don't have targets or objectives. Everybody's trying to optimize his time or her time. And I think today you can look after maybe 20 or 30 clients if you do it properly, not more than that. And in banks, usually you have to look after 60, 80, 100 clients. I just don't think that's right. The client will at some point notice that you cannot really be looking after 100 clients at the same time. It doesn't work.
Right. And why don't you have KPIs? I'm just curious, right? Because I was thinking, like, if you have a business, would you not want to have goals, for example, in terms of how much AUM you get?
I think that would almost defeat our business model and the way we operate. Again, if you have KPIs, you say on what? Assets, revenues, product penetration, selling of products, and all of that we don't want, because we only want to do what's right for the client. If a client is happy with a very conservative bond portfolio, that's perfect. Even if it doesn't yield too much for the RM and for the firm if you want, but it's fine. We're not insisting on pushing a hedge fund because we get a commission on that.
Right. Okay. So the incentives of the RM are aligned with the client, and as long as the assets are growing, that's where your business grows too.
Exactly.
Right. So I mean, you're one of the largest independent asset managers now in Singapore, and so you must have done a lot of things right. as well, right?
I think so.
Yeah, I mean, because there not many people know about EAMs. I mean, a couple of follow-up questions would be, if I'm a client, is there a minimum investment amount I need to put with the EAM in order for me to be qualified to be a client?
Well, actually, it's again, in a bank, normally today you have a minimum of 5 million US. Most private banks wouldn't open an account below that.
Yeah.
We don't have any minimum thresholds, but again, I say below 3 million, I wouldn't do anything because ultimately I will probably neglect that client. So I better don't start. If to someone who has only 3 million and no potential to grow that, I wouldn't start that.
Right. Okay. So there is a soft,
very soft. Every RM decides on his own, by the way.
Right.
We don't impose on them any minimum amounts.
Right. But technically, though, for an investment portfolio to be more diversified,
you need 3 to 5 million.
Exactly,
anyway,
you need around 3 to 5 million, given the minimum amounts for each bond or fund and kind of thing, right?
Yes.
You have been around for 16 years, and many businesses have come and gone. What do you think at the end of the day are clients looking for?
Comfort, honesty, transparency, and consistency. And I think that's what we have shown over the last 16 years. We have very little staff turnover. The 3 partners we've been together since 2012. And I think that's very unusual in this industry. But I think also very important is, I think our business model is maybe slightly different from many of my competitors or colleagues in the industry. Many of them work with what is called retrocessions. So they get a cut on all the commissions they generate with the custodian banks. And as I said earlier, we don't do that. We don't take money from the banks. We don't take money from the fund managers. And so the client knows we really work for them. We don't have to sell a product. We don't have to generate turnover in the account. So we generate revenues for us. And I think that approach, and we say you have to think long term. We believe in a strategic asset allocation that is aligned with the risk profile of the client or the risk appetite of the client. And then we stay the course. We are not trading actively in a portfolio. Because if we did that, we would say we know how to time the market. And we don't. We don't know what Trump is saying today or what Powell is saying next week. So we think we need to filter that noise out for the client and construct a portfolio that sort of withholds COVID or any other shock that the markets will go through.
So what you're trying to say is that not all EAMs are the same as well, right? Because if I play the devil's advocate, and there are a lot of people in the industry that are skeptical about EAMs, right? And they say that, it's just for advisors who go there are mainly to avoid the bureaucracy of banks. But at the same time, the clients don't really benefit because the EAMs still charge high fees, same products and that kind of thing, right? What do you say to that?
Much of that is true, but we don't charge high fees. We charge too low our fees, I must admit. But having said that, I think there's a lot of IAMs today that go out of the bank for some of the reasons you mentioned. They think it's too bureaucratic, there's pressure from the management to sell products and things like that. But they don't change their behavior. So if you go from a bank to start your own IAM or join a IAM and you do exactly the same thing they did for the bank, like selling structured products and selling hedge funds and that, I don't think it's sustainable. I think you really have to change the mindset and you have to understand that you work for the client now. And if you sell products like, structured products and all these different things, you can't really always honestly say this is the best thing for the client.
Right.
And I'm not sure that they sleep well all the time, with all the exposure they have in different structured products.
Right.
I sleep well every night.
Yeah. You're not trying to say that structured products
and my clients too, by the way.
You're not trying to say that structured products are bad.
No, I'm
right?
not saying that, no.
But what you're trying to say is an over exposure, to constant structured product ideas is very distracting to the actual.
I can honestly tell you, I've dealt with clients in Singapore 39 years.
Yeah.
Not once did a client ask me about a structured product. I mean, actively or proactively asking for a structured product. It's a business that we, the industry, have built,
right? And
we have created that demand.
Interesting.
It's not, or the supply rather, and there was no demand really for that. Again, I'm not saying they're bad or all bad. Yeah. Many of them have a place in portfolios, but I think it's just too many of them and too much turnover.
So for you, steady boring
Absolutely.
is
Boring
actually
is
good.
good.
Boring is good.
Yes.
Right? And that could be different from EAM to EAM
Yeah,
as
absolutely.
well, right?
And I'm not saying what we do is right, is the only right way of doing it, but I think our clients are usually entrepreneurs or they have made money, in a business or whatever, and our job is to preserve their wealth. If someone says, I come to you because I want to become rich, I say, we're probably not the right place for you.
Yeah.
Our job is to make sure they stay rich, our clients, stay wealthy, wealth preservation. And that means we have to be more conservative. We don't take leverage, for example, in general for our clients.
Right.
We're well diversified. And I always say to prospects, we're boring, but I think boring is good.
Yeah. So if boring, steady, preserving wealth is of key priority to you, in the beginning years of building this business, like you said, it might have taken a longer time to do that. But would you say it has paid off?
Well, I would do it exactly the same way again. I would not change my stripes. Absolutely not. I think, again, I want to be honest and be able to look in the mirror in the morning and say I've not done anything sort of that I wouldn't do for my own portfolio.
Yes.
And I think it works for our clients.
Yeah. So one thing I've noticed about the benefits of being in a big bank, especially for myself as well, leaving a big bank to a startup at that time, is resources, right? Banks have plenty of resources, right? Whether it's investment research, portfolio consultants, product information. If I'm a client currently in a big bank, a reputable bank, and I'm having access to all these resources, why would I go to you and EAM or IAM if I were to lose all these resources?
You wouldn't. Actually, you gain access to more resources because if you deal with one bank, for example, as a client, you get access to that information from that organization. We deal with a dozen or so banks and have direct access to fund managers. We get all the information from these counterparties. So I think we probably have more than enough information for our people to analyze what's right and what should we do in the portfolios. So no, I don't think that's a reason not to join or not to work with an independent asset manager.
I see. Okay, so what you're saying is, as an IAM, you actually have access to many different banks, so not just one.
Correct.
Right? And therefore, you still have access to these resources. And would you also say then you can give a client a bit of an open architecture in terms of products?
I think as a IAM, we have what we call multi-custodian offerings. So a client may be with you, Bank A, let's not use bank name, Bank A.
Yes.
And he only sees the products of Bank A. But maybe there's something he needs to do that Bank B is better in or has a better product or better conditions or whatever. And so we are, of course, able to bring that client for that business to a different bank. Now, we're not hopping from bank to bank, not at all, but we know what the banks are good at and we think we know what the client wants. So we can channel the client to the right custodian bank. So you have to have the best sort of fit or match if you want.
Right. So does that mean the client has to open different accounts in different banks to enjoy?
Most clients have many bank accounts already. I think the average of our clients is probably 3 to 4 bank accounts at least.
Okay.
But again, I'm not saying you open bank accounts with 12 different banks. That makes absolutely no sense. You have to be focused and concentrated. But some banks are better than others in certain things,
Right.
For hedge funds, for example, we will go to a bank that we know is better than the others.
Yeah. One thing that just struck me is that you then have an overview of the client's overall portfolio in different banks.
Not all clients show us that, but we have a family office offering, as we call that. So we also call ourselves to add to the acronyms. We are an MFO, a multi-family office.
Okay.
And for families that we provide family office work for, usually starts with the aggregation of all the assets. So they have assets in different banks. They may have non-bankable assets, direct investments, property, and we can all aggregate that in one valuation, like a balance sheet for the client that we run on our systems. So we can every month we show them the balance sheet and the performance of the different investments or different portfolios in that balance sheet.
Now that you brought up multifamily office, which is quite the buzzword in Singapore recently, over the past few years, family offices, multifamily offices. What is actually the difference between a multifamily office and an independent asset manager?
I think a multifamily office, well, there's many definitions, obviously, right? And I'm trying to give you mine. A family, when you do family office work, you have the whole overview of the assets of the family. In the IAM environment, you perhaps only manage a certain sleeve of the assets of a family or an individual.
Okay.
But so then you only focus on that sleeve. They give you maybe 5 or 10 million, and you have to run the global balanced portfolio, but you don't see all the rest. Whereas with a family office, you see whatever they have in all the different banks, because we consolidate for them on our platform. So we know what the client has at Bank A, Bank B, Bank C. We may not necessarily manage all those portfolios, but we have the overview. And the client or clients, like family office clients, usually would not give a bank access to all the information they have. They don't want them to see what they have in other banks. We're neutral and we work for them, so they have no problem to share that with us.
Interesting. And that also benefits them,
Yes.
right? So MFO, EAM, these are actually just labels,
Yes.
essentially,
Yes.
right? Right. You can
MFO sounds more sexy, I think.
It sounds more sexy, but actually, essentially, it's just kind of the same
Similar
things, right? Let's talk about some of the challenges of an EAM, IAM. What would you say are the biggest challenges for you?
When we started, the biggest challenge was to explain the business model, because again, clients hadn't heard about that. So very few people offer that in this part of the world. So we had to explain, no, we're not a bank. We don't keep the assets. We just manage it. You keep the assets with the bank and so on. I think that today is no longer a problem. I think the sophisticated clients understand our business model. They have heard about it. They maybe have engaged already with a IAM somewhere. So we don't have to explain really how it works in most cases. I think the challenge is for us to further grow the business is that more relationship managers see the benefits in what we do and what we can do. And I think there's a very big pool of relationship managers in Singapore and the banks. Someone I think said it's about 3,500 RMs in Singapore. But many of them I think wouldn't work in a IAM, wouldn't work out in a IAM because they don't have enough traction with their clients. So they are too junior perhaps. And when you go to a IAM, you have to tell the client, you have to pay me, you know. It's not an army of support staff behind me that carries the whole relationship.
Yes.
So it's me basically. You pay me, not sort of an anonymous bank, right?
Yes.
Or brand. You don't have a brand anyway. So I'm the brand if you want.
Yeah, exactly.
Or that the RM is the brand for the client. So the pool of RMs who would work out in the IAM is, I think, actually probably maybe 10 or 15 or 20% of the total pool. Because you need to have a certain seniority and traction with your clients.
Yeah.
You need to have a certain level of confidence that you can answer the questions that the client has across different topics, not just financial markets, also estate planning, tax, wealth planning, etc. And I'm not saying we're experts at that, but we can have a conversation and then bring in the expert if it goes to the next level. And also very important in Singapore, I think there's a lack of entrepreneurial sort of spirit that RMs don't want to take a risk. They're very comfortable in the bank. As you said earlier, they have a salary, they have a bonus, they have stock options, they have a title, they have a name card with a beautiful logo of a large bank.
Yes.
And that's worth something. And I get that, but to get out of that comfort zone for many RMs is just too much.
Yeah, you almost have to be a very good generalist.
Yes, correct. Absolutely.
Right?
Yeah.
Which you can actually, in the bank, rely a lot on specialists to help you, a whole army of specialists to help you.
I think in a bank, the RM is the conductor. He brings together the treasury specialist, the fixed income specialist, the credit specialist, etc. And he goes for lunch and play golf with the client. That's a bit, I overdo it here on purpose.
but I get it, yeah.
But it's true in a IAM environment, you have to do everything yourself, basically.
Yes.
And so it's a very different relationship also that you have with the client ultimately.
Yeah, because even as a founder and CEO, you do a lot of other stuff apart from managing the business, right?
First of all, I still have my clients, which is what I enjoy most.
Okay. Which you normally wouldn't get in a bank when you're a team head or a department head.
No. You have to let go of your clients usually.
Right. Okay. So you still have your own clients and you still have to do a lot of the more administrative stuff as well. Yeah. Right.
I make coffee myself.
and put your calendar invites yourself.
Absolutely.
True. I mean, those are big changes, to be honest.
Not everybody's willing to do that.
No, you're absolutely
you have
right.
to, again, I think you have to switch your mindset completely. From in a bank, you are looked after, by support staff and all that. In a IAM, you have to do it yourself. When I started, I went to the mailbox and collected the mail and all that stuff. So everything we had to do ourselves.
Yes.
You have to roll up your sleeves but it's very enjoyable, and I think as an entrepreneur, you enjoy that.
Yes, no, these are actually very real and big changes when you actually leave a bank.
Yes.
Right? even, you set up your own thing, but even just to leave the bank to join an EAM, it's a very big consideration for many people.
It's a big jump.
Right?
And I'm not belittling it's a very important decision to make.
Yes.
And a daunting task maybe to make that decision to leave a comfortable bank. Sometimes you can hide a little bit.
Yes.
As a YAM, you can't hide. You're exposed to the client, and the client deals with you because he deals with you, and not because of the brand on your name card.
Right, and basically you hunt for your food.
Yes, correct.
Meaning that
you eat what you hunt.
You eat what you hunt, and also you can earn as much as you want or as little as you want.
Correct. I just explained that to someone the other day. In the bank, you have your bonus, your salary, your bonus. That's usually capped at X% of base salary. In a YAM environment, there's no cap. You, as you said earlier, you eat what you hunt. So if you hunt more, you eat more. You take home more. It's just a percentage that you agreed with the firm on your revenue, on your home take home revenue share. And if you're happy with 100,000 per year, you do what you need to do for 100,000. Or if you want 500,000, you need to do what you have to do to end up with 500,000. But there's no cap.
Yeah.
The sky's the limit, really.
Yeah. Okay. So if I'm a high performing relationship manager in a bank, if I were to join an EAM, what would I get?
Better work-life balance, an environment that allows you to be brutally honest with your clients, an environment where you don't have pressure, and very important, and most RMs don't see that, you can access multiple banks. When you work for one bank, you access the services of that bank and the products of that one bank. But we had a guy who came from UBS after 30 years or whatever, and he realized, JP Morgan has something to offer. Pictet has something to offer. And I think that's a wake-up call for many RMs that, maybe they have a bit of a tunnel vision. My bank can do anything and everything all the time.
Yes.
And not always at the best, not always the best in everything.
True. It actually opens your eyes.
Yes, correct. Yeah.
To possibilities that there are options.
Yes.
Besides what you knew.
Yes.
I know it wasn't easy for you to start in the beginning and set up something on your own. Is there any advice you would give for someone who's looking to even start their own company?
I was lucky in 2009. It was fairly easy to start a business.
It was during the GFC?
Yes. And also in terms of licensing regime, it was much easier. So it was called the notified fund manager back then. You could send your papers to the MES and you could start to advise clients. It's no longer the case. Today you have to submit your license application, and it probably takes 6 to 9 months to get it approved. So meanwhile, you can't talk to clients basically because you're not licensed.
Right.
So my advice would be, unless you have a very, very large book of business that you're very, very sure you will succeed ultimately, join an existing YAM. Plug and play into the infrastructure of that YAM, and basically you have everything on day one rather than you have to build it yourself for the first 6 to 9 months where you don't generate revenues. It's tempting to start your own YAM because you're, again, your own boss and all that.
Yes.
But I think the path to get to being established, have everything in place, probably means you need a bit of savings to survive that period of time.
That's true. And within an EAM, you could also run your own thing,
our arms are very independent.
Right.
I mean, of course, they are employees of HB Wealth Management, but I look at them as little entrepreneurs. They run their own business independently, and they come for help if they need help. So we're not imposing anything on them in terms of, I want to see your client and all that. No. If they need help from the CIO or the CEO, then obviously we're there to help, but they have to run it independently.
Right. So if I'm a family office, if I want to set up a family office, I could actually set it up under an EAM as well, so I can tap on your resources and your licenses.
Right. And the infrastructure and everything.
Yeah, while still being independent and doing what I need to do for my clients.
Semi-independent, I would say. You're an employee of the firm, but you can operate and look after your clients in the method
whatever way.
I mean, there's compliance standards, of course, that we have and all that. So we have to observe that. But how you develop your business is entirely up to you.
Yeah, and the fact that you already have established compliance standards actually protects the employees in a way, right?
And that's maybe one of the misconceptions that RMs have here in the banks. The standards in the YAM are not lower than in the bank. We have the same regulations, famous MES 626 on money laundering. We have to observe all the same things. We have to do the same KYC, know your client, SOW, source of wealth. Everything has to be established and documented. So a YAM is not a shortcut when it comes to compliance compared to a bank.
Right.
But running a business, running your clients, I think is much less bureaucratic than it is in a bank.
Let's talk about investments, right? Because you're called an independent asset manager.
Yeah.
Does that mean that you can manage the portfolio of a client and also are generating performance as part of a portfolio, a bit like a discretionary mandate?
Well, we have to generate performance. I think we couldn't survive if we just were honest and nice people.
Exactly.
We also have to deliver. That's quite clear. We have a team of 5 who, under the CIO, manage the discretionary portfolios. So we have a very disciplined approach. We have a monthly investment committee meeting where we discuss market trends and how we should reposition portfolios. Then we make changes to our strategic tactical asset allocation. But again, as I said earlier, we don't believe we can time the market. So very often we are quite close to the neutral position in the strategic asset allocation, not pretending to know whether interest rates will move up 10 basis points next week, because we don't know. Nobody knows.
Exactly. What are some of the common mistakes that you see investors make today?
Oh, they always make the same mistake.
Which is?
First of all, they think short term. They don't have discipline. And they usually take, on the way up, they take too much risk. And when things have gone down, they take too little risk. And I think the only way to have a successful portfolio, successful return on your portfolio, and you said, I mean, a return that sort of matches your risk profile. If you're super conservative, you can get cash plus a little bit, right? But if you're a bit more adventurous, obviously you can outperform the cash returns quite considerably. But for me, it's very clear. You have to think long term. And one of my first clients I had in Indonesia, an old American guy, he said, Urs, young man, you cannot afford to think short term in investments. And I remember that was back in 1988. And it's so right. You cannot afford to think short term. And when a crisis comes, people usually panic and they sell. That's when they should buy. Invariably, I've gone through the 87 crash, the Asian crisis, the global financial crisis, COVID. Invariably, if you buy when there's blood on the street, you do well. If you sell when blood is on the street, you come back far too late to catch up with the market.
Right.
So discipline, very few people have that. And that's what we have to sort of bring to the client, to tell him, look, don't do this, don't do that. It's not worth it. Stay conservative, think long term, and stay the course, aligned to your risk profile. And that really, I think, gives the best results.
Okay. So imagine if I'm a high net worth investor today.
Okay. Yep.
I'm sitting across you, Urs. What would you say to me, given that the environment is so uncertain, there's a global economic slowdown, what would you say to me?
Again, we cannot time the market. We've said a couple of years ago the markets are expensive, and today they're even more expensive, right? So, but that's 20% higher than 2 years ago. So I would say I would not advocate to rush into the market at these levels. The valuations are quite stretched, but you have to be in the market, because cash is never the best asset class, unless exactly at the day of the crisis, then it's the best asset class, but otherwise it's not. So I would say ease yourself build a portfolio of the next 6, 12, 18 months, but build it in a way that is very well diversified. You don't take leverage, you don't need to take leverage. And again, be on the conservative side. There's no need to take too much risk, particularly not at levels where we are today in terms of where the equity markets are. But be invested for sure.
Right, okay. You're Swiss.
Yeah.
Right.
Yes.
And you actually moved to Singapore in 1986. So you've actually been in Singapore for
39 years.
Yeah, almost 40 years. Almost 40 years.
Yeah. I love Singapore. It's been a wonderful place for me and for my family. We've had wonderful 39 years here.
Yeah.
So no complaints whatsoever.
Yeah, I mean, you've seen a lot of how Singapore has changed as well. I mean, as a financial center and as a hub for family offices and IAMs, EAMs, how do you see things have progressed, and where do you see the future is for asset managers?
Well, if I look back when I came in 86, there was almost nothing in terms of private banking. We had I think UBS had 10 people, Swiss Bank Corporation had a dozen, and Credit Suisse had 5 or 6. That was the private banking world in Singapore back then. And fast forward to 2025, it's a massive industry. It's a big business. Thanks to the regulations here, thanks to the great infrastructure, people speak English, so it's a very well-trained workforce in Singapore. And I think that all helped to bring Singapore to where we are today. I'm very optimistic for Singapore in the wealth management space. I think Singapore will continue to grow. There's competition from Hong Kong again, competition from Dubai, but the wealth cake grows, and I think Singapore will at least maintain its share of that growing cake. So I'm very optimistic for Singapore.
Right. I know you were recently in Dubai. How do you compare these financial centers, and where do you see the growth will come from?
I think for Singapore, it will continue to come from Southeast Asia and North Asia as well, China, Taiwan, Hong Kong. Dubai is very much an NRI business, where people either from the Gulf states or from India, Pakistan do their business, which is more transactional, is more leverage, is a bit different from what we do, for example. And I think Hong Kong will remain the stepping stone into China. If I want to deal or develop a Chinese business, I have to be in Hong Kong.
Right.
We don't have that. We don't have mainland Chinese clients, so I don't have to be in Hong Kong. For us, Singapore is fantastic. Singapore is great for Asians, for Europeans, for Indian subcontinent clients, because again, it has that. People call it the Switzerland of Asia, but it's probably true. It is what Switzerland was like 20, 25 years ago.
There are many young people out there. You hear a lot of people talking about, I aspire to be a private banker, I aspire to be an investment banker. But you rarely hear people say, I aspire to be an external asset manager, right? No. What advice would you give to not just young people, but also people who are currently in big financial institutions who want to venture out on their own, for example, into an EAM?
Yeah, first of all, young people, they need to go through the banks. I think it's very unusual that you make a career only in a YAM or in YAMs, different YAMs. I think it's great to be in a bank to get training in the large banks, but also to start to build a book of business, of clients for yourself. And at some point, when you have the maturity and the relationship with the client, that you feel comfortable to move out of the bank and on your own or join a YAM, that's probably not before 35 years of age, frankly speaking, because you probably need 10 years or so to build that relationship. Then it's probably a good time to move on.
Interesting. Yeah, because I think we don't realize that you actually need to develop and hone your skills in order for you to actually be more independent in this kind of setting.
And I think you have to be, I always tell young people, you have to be very patient. Don't try to be an RM too early. Be an assistant relationship manager for a few years, see how it goes, start to get exposure to clients. Maybe you can inherit some clients, and then you start to build your book of business. For RMs who are in a bank with a solid book of business, I think they should all aspire to be independent at some point. Because again, it's a different relationship that you have with the client. You truly work for the client and with the client, no longer for the bank.
I know you like football too.
Yes.
You're a big football fan.
Yes.
I couldn't recognize your WhatsApp photo. That was you in a football jersey.
Yep. Yes.
Has football taught you anything about career and leadership?
Oh, absolutely. Football teaches to work in a team, because you can't win a game yourself. And I think I couldn't have been successful as a YAM on my own. I need a team to work with me. Football taught me discipline. You have to train and you have to work for the team. And I think that applies in a business environment exactly the same way.
Which is your favorite football team?
Well, in Singapore, everybody talks about English football, so it's Arsenal. But my favorite team is my hometown team of Schaffhausen.
Okay. So Urs, you're running this business for 16 years, and it's been 16 years since you left the bank. Any regrets?
Never. Well, sometimes I think I should have started earlier, done that earlier. But then, hey, we cannot change the past, right? There was at the right time for some reason. I don't regret, not one day did I regret that decision. Not once, honestly.
Final question. Yeah. Are you happier?
Oh, ask my wife. Should ask my wife or my kids. No, I think you have a different pressure, right? When you start the business, you have a different set of uncertainties. Does it work? Do I make money? Can we pay dividends at some point? And at the beginning, when I had basically myself and two colleagues, there wasn't such a big deal, right? We could pay in small amounts of small salaries. But when you build the business and you have to pay salaries to more people, you start to worry a little bit more, right? Because then you have to generate revenues from clients, and it's a different set of pressure. But it's a much more pleasant pressure than what you get from a banking organization.
Thank you so much, Urs.
Pleasure.
This was very insightful, very dynamic, and candid as well. I'm sure a lot of people will benefit from today's conversation and to learn more about the independent asset management space.
Thank you very much. Pleasure.
You.
If you liked this podcast and want to learn more about finance, remember to like, comment, subscribe, and share it with someone who needs it today.